back. We are going to cover the rest of Chapter 8. This is the 5th video, and it's all about LIFO, and that is last in, first out inventory method. It can be very challenging to deal with LIFO, so we're going to talk about some of the most challenging points and ways to simplify it. So let's get started. So one big thing is it's tough when there are frequent cost changes, which a lot of times there are. We're not going to see products be the same cost all the time. So as we see these frequent cost changes, it can really make the accounting for LIFO very challenging. So especially if we have numerous units. Think about a company like Walmart. They have like tens of thousands of different items, and that would be really hard to keep track of that on a LIFO method basis, because you're going to have to keep track of every different brand of soap and every different kind of soap and every different chocolate and every different nail polish and food and towels and electronics. I mean, there are so many different things that they would have to track this way. So we're going to talk about some ways to simplify that. So first, we're going to talk about inventory pools for LIFO in order to make this a little bit simpler for companies that do have so many different types of items, especially when their prices vary a lot. And then we're going to talk about the dollar value of LIFO. So that's going to be what we cover in this video today. So we're going to start out with those LIFO inventory pools. So inventory units grouped into pools based on similarities of individual units is what we're talking about here. So we are going to pull together all of those units that are very similar. So maybe it does have to do with grouping together soap or grouping together different electronics or different towels or whatever it may be. Pools are assumed to have been purchased at the same time and at the same cost. Units are converted to averages. So when you do purchase more of these items, we just take the beginning inventory plus the single layer added during the period at the average cost of the pool. So as we add more, we're going to be adding it here to the beginning inventory, and that gives us our ending inventory for everything we still have sitting there. So it always makes it a lot simpler when we have an example. So let's jump into our galactic gadgets. This is our last video for Chapter 8. So the last time we're going to see galactic gadgets, make sure you watch Chapter 9 to see what our next company will be and what we're going to cover there. So Galactic Gadgets has an inventory pool of circuit boards that includes 3 types. They've got standard boards, advanced, and quantum. The beginning inventory consists of the following. So this is all the beginning, and then we're going to see what we add to it in the next slide. So we have our standard boards. We've got 400 boards. It cost us $45 each, so it's $18,000. Then we have advanced boards, which we have 250 of. Those were a lot more expensive at $70 a piece. And then quantum boards, we only have 150, but they cost us $120 each. So what we're doing here is we add up all of the quantity. We have a total of 800 units, and then we look at the total cost. We're pulling all of these together to make it simpler for LIFO. So we're going to pull these together because they're very similar, and we take the total $53,500 that was spent on these, and then we divide it by the quantity, and it tells us the average is $66.88. So that would be our average cost for the pull of the boards that we have at this point. And in our next slide here, we're going to look at the ones that we add to the pool. So during the period, Galactic Gadgets purchased additional boards. They bought all these extra ones, another 600 boards total at varying prices. Some of them are actually less expensive. And then we look at the total cost. So this time around, they spent a total of $40,600, and they bought 600 units. So when we divide that, we get an average of $66.67. So we had our previous amount, then we have our new average. So let's look at those together. We had average for the beginning pool was $66.88, and then just slightly more, the average for the ones purchased in the pool were $67.67. So we now have a total, when we take our beginning inventory plus the LIFO layer that we added, we have a total of 1,400 units. and then we put in those averages that we figured out for the cost, and then we see our total is $94,100 for these different boards. So that's our LIFO inventory pool as we put those boards together. Now let's look at dollar value LIFO. This is a little bit different. An inventory method that applies to LIFO that are those inventory pools, but they're based on a dollar value, not the physical units. The categories are pulled together considering items that are likely to face similar changing cost. So different. The other one was all focused on, okay, these are all really similar products, but they vary a good bit in price and how much their prices are going to change. But here we're actually pulling things together based on the dollar value and how likely they are to change at the same rate. So cost indexes, the purpose to remove the effects of price increases, allowing both beginning and ending inventory to be expressed in the same base year price level. So what we do to get this cost index in layer year, we take the cost in the layer year divided by the cost in the base year. The base year would be what we are basing it off of, what we're going back to and comparing it to, and that helps us to see how much it went up. So when I say a cost index, I'm talking about basically inflation here. How much did the price go up based on inflation? Because here's the thing, we look at cost and we say, okay, this used to cost me $50, now it costs me $55. Was all of that because of inflation, or was some of that for other reasons? Did we change suppliers, or did that company just up their prices more than what inflation would have been? So what we do here is we look at the difference in the cost, and then we consider how much the cost index has increased, how much inflation has gone up, and that helps us to compare to see if it was all because of inflation or if it was partly because of other factors. So this is a 3-step process. So step 1, we convert ending inventory to base year dollars. So then we are going to compare to the base year inventory to find what the real increase is, and then we apply the appropriate price index to new layers. So I give you a second if you want to take a picture of that, or you want to write that down. For me personally, I'm always like, okay, that's a lot of words. I don't know what it means at all. I do right now, don't worry. But as a student, I'm like, okay, that's a lot to take in. So for me, maybe for you, examples help a lot. So we're going to jump into an example so that we can see what we're actually talking about and how to apply this to Galactic Gadgets. So they adopted the dollar value LIFO method January 1st, 2025. The inventory at a base year cost was $500,000. So that's our base amount, $500,000. At the end of 2025, the ending inventory at the current year cost was $575. And the cost index for the year was 1.10, so 110%. So in other words, it was like it went up 10% for inflation. So now we're going to look at that step 1, convert ending inventory to base year dollars. So we take ending inventory at the base year, and then we are going to divide it. So we're going to take the 575, this is what our ending inventory was, divided by the cost index. And that gives us 522,727. Okay, so we're going to take that 522,727 that we got in step 1. And now we go to step 2, compare to the base year inventory to find the real increase. So we started out with 500,000. Then we see that the quantity would have gone up by that 22,727. This is where we got that from. I'm going to go back. Let paper airplane backwards. So see, it was like saying, okay, considering what the inflation was, it actually, instead of 575, that same amount would have been the 522,727. So it went up from 500 to 522,727. So that helps us to see that how much it increased because of quantity. Then the rest of it was based off of that 10% increase. So then we take the 522,727 times the 10% increase, and we get our 575. So in other words, we started with 500,000, we really added 22,727 in quantity to it based on new inventory coming in to this pool. but due to the 10% increase, it went up by another 52,273. So hopefully that's making sense. This is a lot, I know. But let's look now at step number 3. Apply the appropriate price index to the new layers. So we take the 500, we multiply that times 1 because this is without any cost index, without any inflation. So it's 500,000 is our ending inventory based on what we already had. Then we take that additional 22,727 that we added based on quantity, more inventory coming in. We multiply that times the 1.1 because it went up by 10%, so we have 110%. And so we say that the ending inventory for that would have been 25,000. So when we add that in, it's like saying it would be $525,000 based on the dollar value of LIFO. All right, the advantages of this, and then we end this chapter. We end the inventory methods. Of course, chapter 9 is all about inventory as well. It's just a little shift, and we look at reevaluating the costs and such with inventory. But the advantages of using this complicated method is it reduces record keeping for similar items, so we can pull things together. Better reflects real inventory increases, so we're kind of taking the inflation out of it and we're considering, okay, what's really going on with inventory here, and helps manage taxable income in inflationary times. So that is helpful as well. All right, so make sure you subscribe so you don't miss the next videos. I want to make sure that you get all of this information and we can walk through these together.